call the investment committee meeting to order, and I'm going to ask Beth to take a roll call for the meeting.
Yes, Trustee Martin,
Here.
Trustee Riley,
Here.
Trustee Moore.
Here.
I believe that's everyone that I see. And then we have the non-voting committee members, Matt Scaves and Jim Bradley as well.
Here.
There you are. You know what, Matt? I didn't see you on. I had to scroll. So welcome.
Thank you.
All right. So I'd like to welcome everybody to attending the investment committee meeting. And I'll see some of you at the meeting in Fort Kent this Sunday and Monday. I'd like to start with the approval of a non-voting, non-trustee member, and that would be Jim Bradley to a second term. And I wanted to speak a little bit to that this morning. So our non-voting members, for those of you that might be newer to the committee, and for those of you listening to the investment committee, are people that have expertise in the field. Investment committee, the decisions that are made here sometimes it requires a knowledge that is not known to all. I mean, we all have retirement accounts, but the technicalities it definitely requires a certain type of expertise. So we call on people that are professionals in the industry to help with decisions. They don't have voting privileges, but they definitely do help us quite a bit with the decisions for the investment portfolios. So today we are discussing Jim Bradley, and he has finished he's coming to the end of his first term, and we're recommending a second term, and he's so graciously agreed to do so. I just wanted to read the background on Jim so that everybody knows. Jim Bradley is a founder and chief investment officer of Penobscot Financial Advisors with offices in Bangor and Portland. With $460 million in assets under management, PFA provides comprehensive financial planning services to over 700 households, including advising many UMS employees and retirees. Graduate of the University of Maine of Connecticut, University of Maine, listen, I'm embedded, it's embedded in me. University of Connecticut, Mr. Bradley is a certified financial planner, which for those of you in the industry, that is, that's a very, very great designation to have, and definitely somebody that you want to be dealing with. He's a chartered financial analyst and chartered alternative investment analyst. He also serves on the board of Hospice Volunteers of Hancock County. So as you can see, very well served by Jim. Matt, I don't have your pedigree in front of me, but I just want to say that we have very good professionals in the non-voting positions on the board, and the reasons why we ask for their help. So did anybody have any comments before I read the text of the proposed resolution for Jim's second term? Everybody's got big
oh, thank goodness he's agreed to serve again.
Yes, I agree. So,
well, thank you very much for that. And as I told Tracy, I feel like I get at least as much out of these as I put in. So thanks so much for letting me stay on for another term.
Thanks for agreeing. So I'll read the text of the proposed resolution that the Board of Trustees, acting through the Investment Committee, approves the reappointment of Jim Bradley for a 3-year term as a non-voting, non-trustee member of the Investment Committee effective May 16, 2024. And Beth, I will turn it over to you for, do I have a motion?
So moved.
So moved by Chair Riley, and a second by Trustee Moore. And Beth,
we might want to put in the record too that they're independent. There's no conflict. They're independent advisors to us.
Yes. Yep, definitely. They are independent. Thank you, Chair Riley. Beth, I'll transfer it over to you.
Can I just note, I just
Sure.
wanted to note, I have a daughter that graduated at UConn, so I have a lot of sweatshirts that look exactly like the one Jim has. And the nice thing is, if you stay far
I
enough
was
away from
wondering
the
if I
cameo,
needed to cover that up for this
well, if you
particular
stay far
thing,
enough away,
yeah.
it looks like a USM Husky. So
There we go.
Ryan, I never would have noticed that. That's funny.
I'm hoping the chancellor will give me a pass on this.
So Beth, go for the roll call.
Okay, sure. Trustee Martin,
Yes, I approve.
trustee Riley,
Yes,
trustee Moore,
Yes.
the motion carries.
Thank you. And moving on to the second item on our agenda, I see Kelly Regan and Matt are here this morning, Matt Landine from NEPC. And Kelly, I'm going to transfer it to you for a capital markets review and quarterly performance. Thank you.
Great. Thank you, Trustee Martin. It's good to see everyone. Good morning to all of you. Happy to be here. Just as a reminder, Matt did attend the meeting briefly last time we met, but just as an introduction again, Matt is joining the relationship with me on your account. He's a consultant here at NEPC, has been here for a number of years and works with endowments and foundations similar to all of you. So happy to have Matt here. Just before I turn it over to Matt to give you an update on the markets and the performance, just wanted to lay out today. So Matt will go through markets and performance. I will then dive into a global equity review. And part of that review is looking at ways to improve the fossil fuel exposure in the managed investment pool. So we'll talk about that. After we finish with that section, I'm going to go into a global asset allocation review, specifically on your manager Newton, where there's an opportunity to also reduce fossil fuel exposure there. And I've asked Newton to join the meeting around 10 a.m. To talk about their strategy to reduce fossil fuel exposure. So we will have some additional guests coming around 10. So with that, let me share my screen and get that set up. And then Matt, I will turn it over to you.
Great. Thanks, Kelly, and nice to be with you all today. So lots happened in the markets to start the year, and I think maybe the best place to start would be slide 11, Kelly, if you don't mind, just taking a look back on how markets performed. You can see in that top box, risk assets really did well. I mean, S&P 500 up 10.6%, right above it. The MSCI ACWI, which is sort of a representation of all global equities, was up 8.2%. So overall, really strong. On the credit side, not so much. The strong economy that we saw flow through in the equity markets sort of reduced recession concerns, which put upward pressure on rates, which then had a negative impact on fixed income. And so that's representative, maybe the Bloomberg US Ag down there, that second line of the credit, down about 80 basis points. Now, this is through March, and if you would have looked at it through April or even today, you would have saw April was a pretty down month for risk assets, but throughout May, it's recovered to about these same numbers I would expect it to be, S&P 500 somewhere up in that 10+%. So that's how it's performed. Maybe let's switch gears to the next page, a summary of sort of our market outlook going forward. We've identified 5 here. The first one is something that we've been talking about for quite some time, which is this idea that we believe interest rates will be higher for longer, at least higher and longer than the market has priced in. That's for a couple of reasons, one being stickier inflation, strong economic data, which we're starting to see flow through, and we have a chart in the back that we'll walk through briefly to illustrate that. The second would be about this Magnificent Seven and the dispersion we're starting to see with those companies. If you recall, back in 2023, a lot of the return, or the vast majority of the positive return coming through in the S&P 500 was from these 7 companies. And you'll see now that a lot of them are still doing really well, like NVIDIA, but some, have negative returns through start the year, things like Apple and Tesla. So we're starting to see some dispersion between those companies. The third listed here would be this market breadth and how it's expanded beyond just the Magnificent Seven. So whereas last year we just mentioned sort of just really narrow return focus within those 7 companies, we're starting to see that expand. And as that happens, it sort of re-underwrites or reiterates our value bias that we have, especially within US large cap. And these last 2, maybe not quite as important to your portfolio, but I'll still touch on them. One being cash yields are still pretty attractive. So to the extent that you have excess cash we're okay holding that. And then finally, within high yield fixed income, spread levels are near historic lows, but the all-in yield that you're getting for investing in that is still pretty compelling relative to some other risk assets like equities. So the following slides, we have a number of supporting ones. I'm not going to touch on all of them. I would like to stop quickly on this page that Kelly has shown, just to show you that sort of the S&P rally that we've seen has extended beyond that Magnificent Seven. We're representing that by the S&P 500 line, sort of the teal. For much of the time, it's been on top in this chart. But you can see towards the end of March, the Russell 1000 value and RAFI 1000 are pretty much on par, which isn't something that we saw in 2023. And then maybe real quickly on that next slide, Kelly, just to show the return composition of both the S&P 500 and the Russell 2000. You can see on the left, the S&P 500, that dark blue rest of index. That's a lot larger than you would have seen if you saw this in 2023. There are still some really strong performers, as we mentioned, NVIDIA at the top, really additive to performance there. But then the two we talked about, Apple and Tesla, actually, contributing negatively to retracting from the S&P 500. On the Russell 2000, sort of similar dynamics. You can see there's rest of index is maybe a little bit more, but there are still a couple companies really driving a lot of the performance. Supermicro Computer and MicroStrategy, really sort of a similar NVIDIA play we saw in the large cap is playing out in the small cap as well. If we want to skip forward maybe 2 slides, quickly touch on rates here. So this just shows the changes in market expectations for rate cuts over time. We have the green line being as of the end of Q3, the light blue, the end of the year, and then the dark blue sort of where we stand right now, or at least a representation of that. You can see as we went into the end of the year, we started seeing inflation numbers come in a little better. So the market started pricing in the likelihood from the Fed to cut rates. And I think at that time, it was roughly around 6 that we were expecting for 2024. But you can see ever since then, and the start of the year, we've had stickier inflation come through with strong economic data. So markets are starting to pull back on those expectations. And that dark blue line you can see is even slightly above where we were at Q3. And right now we're expecting somewhere in the range of 2 rate cuts for the rest of 2024. Despite that, equity markets, as we saw, has been pretty resilient, with S&P 500 up roughly 10% in that time frame. So the next slides are all sort of supporting. So maybe I want to jump ahead in the interest of time just to our portfolio positioning reviews on slide 21. Just to bring home our outlook and then how that translates into actually we're recommending client portfolios to position. The 4 we've identified here, the first being the global equity managers are still pretty compelling from an active standpoint. So this is an area with good alpha opportunity. There's a lot of dispersion between the sectors and geographies that they can play in. So if you find a good manager, they can really add a lot of value over time. And this is something that Kelly will be diving into a little bit more deeply in the global equity review. We do have a few options for you to consider there. The second one, just to reiterate that we do like value exposure. We know it's been difficult in 2023, but as we saw with that market breadth returning, 2024 has been a little bit better for those value strategies. It's somewhere that we really like going forward. In your portfolio, you do have some current managers that demonstrate that value bias. And there's also one of the global equity managers that we'll be talking about, that's a component of their strategy as well. Last 2, maybe not quite as applicable, I'll quickly touch on them, but the first one being, this is a favorable environment for real assets, but primarily that's implemented within the private market space. So a portfolio like yours that doesn't have a lot of private markets or isn't interested in investing in private markets, it's not really all that applicable. And then the final one that we talked about already, the cash rates that we're seeing are still pretty attractive. So we're okay holding cash to the extent that you have any extra in the books. That's really all I wanted to cover on markets. I know that was pretty quick. Are there any questions before we jump into performance? Okay, not hearing any. Maybe we can skip ahead to slide 23 in the performance. We're going to start with the operating fund. You can see in that top left chart, it's currently at about 277 million, which is about a $6.1 million increase from last quarter, combination of performance and inflows in January. Currently, it's pretty conservative portfolio. About a third of that is in cash. That liquidity pool, that teal-ish color in the pie chart. All of the assets are in line with targets and the ranges that you've established. If we transition over to the performance in the top right, you can see it's performed pretty well. It's in line with the allocation index, given that the vast majority of it is in cash or fixed income, so less risky assets with less opportunity for alpha. This is something that we would expect to see sort of be close to the allocation index, as you're seeing here. In terms of recent actions and recommendations, there are no manager announcements, but there is the recommendation that Kelly mentioned at the top about the Newton Global Real Return and how we're implementing that portfolio. So we'll talk about that in a little bit. If we switch to the pension, so currently at about 18 million, which is about a 300,000 decrease from last quarter. About 800,000 of that was in flows, with a positive $500,000 coming from performance. This is a more aggressive portfolio. You can see global equity, roughly 30% of the portfolio there. I do want to quickly point out the real assets at about 7.7%, the sort of top left of the pie chart. The target there is 3%. We're still waiting on some cash to come back from principal. So once that comes back, that will come down and fixed income will come back up closer to targets. Even with that, you're still in line with the ranges that you've established. In terms of performance, this is somewhere where, given the little bit more aggressive portfolio, more active management, you can see some short-term performance deviation, especially relative to the allocation index, just depending on how managers are doing. In this quarter in particular, some managers dragged, and we'll talk about those in a second. But over the longer term, the 1-year time period, some of the defensive positioning with positions like Lighthouse, kind of a drag relative to your policy and allocation index. In terms of manager announcements, there is one that we'll get into in a second, just Vanguard tips, but then also that recommendation to evaluate the Newton Global Real Return strategy, as we talked about for the operating fund. And then finally, for the managed investment pool, currently sitting about 397 million, which is a $19.6 million increase from last quarter. There was a small $200,000 in outflows, but $19.8 million improvement from performance. This is something, if you look at the performance, it's a more diversified portfolio. It's been in line with targets and ranges, and for this quarter, in line with the allocation index. There were some managers that was a drag in performance, and we'll talk about those, primarily Walter Scott, Mondrian, and Aberdeen. Walter Scott and Mondrian had pretty strong absolute performance, but did trail their benchmark. And Aberdeen had positive performance, but have trailed, in all time periods. And that's something that we'll get into in the global equity review and talk about potentially terminating that manager. From the ranking standpoint, you can see strong rankings for the near term, sort of the top third or top half. So above median there. The longer term, we are trailing a little bit, but that's sort of to be expected. A lot of ENF clients that we're comparing it to in this peer group have private markets, roughly around that 10% time frame. So your portfolio will do better when public is outperforming private, which has been the case. But in the long term, we do expect private to sort of have that, what we call illiquidity premium, and where it will outperform in those longer, 5, 10 plus time periods. The Vanguard tips is also a manager announcement we'll talk about for this portfolio. But we do, in addition to the Newton Global Real Return implementation, we have the global equity review that Kelly's going to be walking through that impacts this portfolio in particular. And Kelly, if we go forward one page to the due diligence monitor, this is the Vanguard tips I was talking about. The highlight is that there's no action required from you all. We're comfortable with the change. Just Tim Buckley, the CEO, is retiring at the end of the year. They're searching for a replacement, both internally and externally. Greg Davis, who's the current CIO, is sort of taking on some additional responsibilities in the meantime. Any questions on the high level performance before we jump into manager specific stuff? Okay. Okay, so let's jump into the managers. We've already talked about the top line performance. We're going to start with the manager investment pool because that's the largest in terms of the number of managers here, and there's a lot of overlap with the other tool too. If we start with the SSGA fossil fuels, that's a relatively new strategy. You can see the 1-year return up 30.4%, in line with this benchmark. But when you compare it against the S&P 500, which is really what it's in place for, it's actually outperforming, it was up 29.9%. This is something that will do better or worse than the S&P 500 just based on how energy is doing. So it is a passive strategy, but it's excluding that energy that we've talked about. And then right below that, the domestic small and mid cap composite. This has performed well in all time periods from a return standpoint and versus peers. You can see over the longer term, the 5 and 10 year, that ranks in the 16th and 32nd return peer group respectively. They have both growth and value manager. You have both a growth and value, so they can sort of yin and yang at different times, which has been beneficial for that composite. On the global equity side, this is something we'll be talking about, quite extensively here in a little bit. But currently, you have the Walter Scott Global Equity, sort of a conservative growth manager, has had strong absolute performance. For this quarter was up 7.4%, but over the 1 year, you can see up 17.8. So versus benchmark of 25.1. So really strong performance, did underperform slightly, but even longer term, 3 years, it ranks pretty well versus its peers at the 35th percentile. We move to the total international equity. A couple managers here. Silchester, you can see not doing quite as well. It was 1.7 for the quarter versus the benchmark of 5.8. This is a manager that's really not going to keep up in up markets like we've been seeing for about the past year, but hopefully in down markets, it's going to protect a little bit more. On the flip side, J.O. Hambro's a little bit of a different story. They performed really well this quarter, up 8.4%, so outperforming the benchmark. But you can see those longer term numbers, but the 3 year, still in the negative, down 1.4% versus the benchmark of 4.8, and ranking pretty poorly there. So good on them for doing a good job this quarter, but that's something that we want to see continue going forward as sort of make up ground that they lost a couple of years ago. In terms of this quarter in particular, what they did well, they had some overweight to technology, they were underweight consumer staples, and they had some good stock selection with healthcare and industrials. Axiom right below that, very similar story to J.O. Hambro. They had a strong quarter, but they're lagging over the longer 1 year time period slightly. For this quarter in particular, they had some industrials and technology and consumer discretionary positions that really did well for them. And then finally, at the bottom of the page, the emerging markets composites, both Aberdeen and Mondrian struggled relative to their benchmark. I'm going to skip down to Mondrian for a second, come back to Aberdeen. But for Mondrian, this was the small cap exposure within the composite. And I quickly want to highlight, if you look at the 1 year return and look at the benchmark, the MSCI emerging markets small cap was up 20.6%. And if you look 2 rows above that to the MSCI emerging markets, up 8.2%. So that emerging markets of the 8.2 is made up also of the small cap. And you can just see how large the delta was between the large cap EM and the small cap EM. So although Mondrian underperformed that EM small cap benchmark specifically, it was a really good place to have assets in EM, to have that small cap dedicated manager. And strong absolute performance came through up 13.9 over the past year. Aberdeen, as I mentioned before, sort of struggled in all time periods here, and we're recommending terminating as part of the global equity review. Not only has return struggled, but they've had a number of senior level departures. Another one was actually just announced after these materials came out. So that's something we've been looking at and are recommending clients take a look to potentially terminate and replace that manager. And Kelly will walk through the specifics, whether it's a like for like, or we replace maybe with a global equity manager that has EM as part of it. Okay, Kelly, do you want to move to the next page and quickly talk about fixed income? So the goal of the fixed income composite here was really to construct a diversified fixed income portfolio that outperforms the Bloomberg US Aggregate Index, which is what the majority of E&F clients use as their benchmark. And you guys have done that. I mean, you can see over all time periods, it's beating the benchmark and it's ranking really well. I'll take the 3 years as an example where the benchmark was actually negative, down 2.5%, but the portfolio was actually slightly positive, up 20 basis points and ranking in the 38th percentile. A lot of that, especially in the near term, is due to the two more active managers here, BlackRock and Bain. So BlackRock being the one that can sort of provide this less correlated alpha. They go to a lot of different spaces, and that's worked out well for them. You can see the 1 year up 6.7% versus 5.4 for its benchmark. The Bain Capital Senior Loan Fund, this is your bank loans fund. It's really added value as rates have risen more recently. You can see up 12.6%, which is pretty staggering for the fixed income. On the GAA side, the one manager here, Newton, we're recommending a change in implementation, not necessarily in the strategy. You can see the quarter up 5.2%, ranking in the 29th percentile. So really strong performance there, but longer term out to the 3 and 5 year, a little bit more muted. The 3 year, still positive at 1.5%, but trailing the benchmark a little. This is another one where in up markets, it's probably not going to keep up as much as your equity portfolio is. But in down markets, the idea is that it's going to help protect a little bit better. They do have sort of two components here, one being their current return seeking core layer, and then sort of wrapped around that is this stabilizing layer. So the reason for the outperformance this time is within that core return seeking layer, they've had some really strong performance in some tech funds like NVIDIA, Taiwan Semiconductor, Microsoft. We've also had some healthcare stocks like Lonza and Eli Lilly that has really, proved fruitful, as you can see in the quarter to date number. And then finally, Lighthouse and Landmark. Lighthouse, very similar to Newton in terms of, probably not going to keep up on the upside, but on the downside, they'll protect a little bit better. You can see that's proven out in the 5 year number, up 8.2% versus 6.8 for the benchmark. So we still like Lighthouse. And then Landmark, take these numbers with a little bit of grain of salt. These are time-weighted returns. For a private markets manager like Landmark, you generally want to judge it against the internal rate of return or a dollar-weighted return. It's another way to put it. We do have a page later that you can look at that just shows that. The IRR for this return or this manager in particular is about 11.8% since inception, which is generally in line with other managers of similar strategies. And finally, maybe if we skip forward to the pension plan and talk about some of the managers that aren't in the MIP portfolio, one being Baird there. So you can see it's had strong relative performance across all time periods. So really strong there, primarily from credit selection. And then down towards the bottom of that page, Principal down negative 9.9% relative to the benchmark of 11.3. So outperforming, but that negative performance just really because of the general dynamics in the real estate market. So nothing sort of unexpected about that return profile. And then finally, within the operating fund, the next page, the PIMCO All Asset towards the bottom there, you can see it's outperforming its benchmark in all time periods. The rankings might not be quite as good as you would see from some other managers. It's going to be really different from peers. So other managers in this space might have something similar to like a 60% equity, 40% fixed income type profile. PIMCO's one to have a little bit less equity. So in markets where equity performed really well, like they have over the past year, they're not going to perform quite as well. However, what you're getting in return is hopefully a little bit more stable absolute return, and then also some diversification in the form of like inflation protection. So that's all the prepared comments on the performance. Happy to dive into any of these in more detail if you'd like. Just want to pause to see if there are any questions.
Matt, you might have gone over this in the past, or Kelly might have, but the ESG rank on the right-hand side, could you just explain the numbers?
Sure, I can take that one, Matt. Thanks for the question, Jim. So the ESG rank, so if you remember, I might get my year wrong, but around 2017, 2018, ESG became part of the policy to consider managers and that incorporate ESG in their investment process. And so the ESG ranks are an NEPC internal rank of these managers, where we have identified things at the firm level and things at the strategy level with regards to ESG and have ranked them. So for example, income research and management on this page is ranked 1. That means it has a good ESG process within their investment process. For example, Lighthouse ranked 4. They don't really take ESG into consideration in their investment process. So it's a ranking scale of 1 to 5, 1 being the
Thanks.
Any other questions for Matt or myself before we move into the global equity section? Okay, wonderful. Thank you, Matt. Really appreciate the update. All right, I'm going to move forward to page 110, so bear with me as I'm scrolling through. There is a lot of additional information as I'm scrolling through it on managers, portfolio performance, risk statistics, that we don't typically review with the committee, but it is here in the deck if you'd like to see some of it. Okay. So global equity manager review. So just to start, Matt and I went through analysis, and it started with two things. One, the emerging market equity manager. As Matt mentioned, Aberdeen, we've had a few announcements. One is the retirement of the deputy head of emerging markets. And then there has been turnover over the past few years. So all combined together, there's been more turnover. And in addition to that, NAPC has recently downgraded the strategy from a 2 rating. So again, we have a rating scale from 1 to 5. A 2 rating is a highly rated strategy, and we've downgraded it to 3, which is more neutral. In addition to that, you just saw the performance that Matt walked through. So part of the analysis was to look to replace Aberdeen. The other part of the analysis was to continue to work on your fossil fuel divestment policy. And within the managed investment pool, a lot of the fossil fuel exposure does come through the equity managers. And so that's what we did here. We took global equity, which is a theme at NAPC, one of the current opportunities, as Matt mentioned, where we think managers can have a better potential to have alpha. And part of this is due to their flexible nature to diversify their portfolio across geographies, capitalization, and sectors. So we looked at a couple things. We looked at option 1 that is later in this presentation, which is just to find one global equity strategy to complement Walter Scott, your current manager. And then option 2, which is actually the first option that I'm going to spend more time on, is really looking at ways to reduce managers that have those high fossil fuel exposures and maybe adding in 2 additional global equity managers to help with that. And with this option 2, we can use these global equity managers as a way to replace Aberdeen, because some of these global equity managers have emerging market equity exposure as well. Again, we're going to go through option 2 first, but if the committee does not select to move forward with option 2, I will review slides with you on a replacement option for just Aberdeen if we don't want to go the global equity route. So moving into option 2, and I know this is weird that, we start with option 2 versus option 1, but this is our recommended approach for the managed investment pool. And just to start here, I had mentioned this a little bit, but at the top of this page, you can see these 4 managers: DFA, J.O. Hambro, Axiom, and Aberdeen. They all have about 0.5% of the fossil fuel exposure for the MIP, which is about an estimated $2 million. And as I mentioned, we think global equity strategies can be positive for portfolio. In addition to that, there are global equity strategies that have a sustainable focus and that tend not to invest in fossil fuels. And so we have a preferred list of strategies that you can see here in the 3rd bullet, which includes Schroders, Rockefeller, Impax. And then we've also listed Lindsell Train, which is not necessarily a sustainable strategy, but their investment process doesn't typically allow them to invest in fossil fuels. So what we did was look at these sustainable strategies, and complemented that with some of the managers that you have in place today, but did a focus on kind of, what if we terminated those 4 managers at the top of this page. So just a little bit of background here on these global equity managers. I'll just start. I'm only listing 3 here: Lindsell Train, Impax, and Rockefeller. I will note that while Schroders is a manager on our preferred list and is 1 rated, we've excluded from the analysis just because of the short track record. So wanted to focus on managers that have a longer history of managing these types of strategies for the University of Maine system. So just at a high level, there's a lot of information on this page, but just at a high level, starting with Lindsell Train, this is a manager, it's a very high conviction manager that we have. They have a very concentrated portfolio of holdings, typically around 25 holdings. And so what they try to do is they try to find good, sustainable assets that are underappreciated by the market over the long term. And this manager tends to have a little bit more of a value focus to it. So again, if you remember Matt's comments, we do like having some US large cap value in the portfolio. And Lindsell Train does invest in both US large cap and international. So there is that value approach. Lindsell Train also underweights the Magnificent Seven names. So again, you get some of the Magnificent Seven exposure through the S&P 500 fossil fuel free index. But again, this strategy can diversify a little bit away from that Magnificent Seven exposure, which we do have some concerns on over the long term. In terms of the investment approach, it's really most similar to like a Warren Buffett-like approach, where they're identifying companies that have been around for really the last century, and they expect to continue to be around for the next century. So it's a very low turnover type portfolio. And because of this type of strategy, given its concentrated nature of about 25 holdings, it can have periods of time where it has high tracking error, meaning it can deviate from the benchmark because it's a little bit more benchmark agnostic. And that tracking error can mean positive deviation from the benchmark or outperformance, or negative deviation from the benchmark, meaning underperformance. So again, very strong strategy, but again, I want the committee to be aware if we do move down this path, it's important to give a manager like this more time to assess them over a market cycle, given that high tracking error. The Impax strategy. So Impax is a very interesting firm. They have a lot of experience in really looking at thematic strategies. They have gender lens strategies, which focuses on, how many women are on the board of companies and invest in those types of companies. This specific strategy is focused on environmental. So they're really trying to research the policy and legislation drivers of companies in order to see a transition to a more sustainable economy. And they focus on global businesses that are energy efficient, are focusing on renewable energy, water, food and agriculture related markets. And this specific strategy is not allowed to invest in fossil fuels. In terms of the team here, we have a team of portfolio managers and also a team of scientists, which is great at looking at the environmental approach, bankers, venture capitalists, and legislation specialists. So very well-diverse and well-rounded team focused on the global equity space. In terms of this strategy, it targets about 250 basis points of gross outperformance above the MSCI ACWI, and is expected to perform in line with markets. Specifically, we'll do a little bit better when markets are moving up, and will not protect as much on the downside, whereas Lindsell Train would protect more on the downside. So again, these two strategies together would be nice complementary strategies. And as you'll see later on, these are the two strategies that we're recommending the committee consider. Just a note on Rockefeller, while it's not a recommendation to hire this strategy, we did include it in the analysis, so you'll see some of the numbers. But this is a strategy that still is highly rated at NEPC, but the performance has struggled a little bit more in recent years. And some of that we're attributing to kind of the hesitancy around the political environment on climate change issues. We've also seen assets in the strategy not have so much of an uptake compared to what we've seen with Lindsell Train and Impax, so a little bit lower in terms of assets under management. If we move forward to page 115 here, what we've done is we've modeled your current portfolio, this current target allocation. You can see the managers listed on the left and the current target weights to the managers. So this is the current MIP portfolio. And we've modeled kind of alternatives. So the alternative Option 2, Lindsell Impacts, is what we're recommending today. And you can see the corresponding weights and how that would change across your current managers. So for example, we would be reducing SSGA from 25 to 14.5, reducing small cap. So today small cap's about 5%. We would be reducing that to 3% with one manager. And then within your international equity strategies, Silchester, J.O. Hambro, and Axiom, just maintaining Silchester is your sole international manager. And then within emerging markets, just maintaining Mondrian. So again, this would be terminating Aberdeen. With that capital of the termination of some of those managers and reducing some of the managers that will stay in the portfolio, you can see that capital would be going to Lindsell Train at 10% of the portfolio and Impacts at 10%. And this is of the equity portfolio. So overall, you can see about a 30% allocation there to global equity strategies. I just want to make a note here. So the core of the portfolio would be global equity at 30%. But what we've done with the remainder of the strategies, the SSGA, the Westfield, the Silchester, and the Mondrian, is weighted them at NEPC's recommendation for market weights for equities. So that would be 60% of the assets outside of global equity within US equity, 25% within international equity, and then 15% with emerging equity. So you have a core portfolio of global equity, and then the surrounding pieces of it of US international emerging would be in line with NEPC's strategic recommendations. In terms of kind of, if we look backwards on what this portfolio would have done and look forward on potentially what we would hope to expect from this portfolio, you can see down here in the risk return metrics. So for example, in terms of the annualized return looking backward, you can see that this portfolio would have a slightly higher return with slightly lower volatility or standard deviation, resulting in a higher Sharpe ratio. You know, looking forward on the annualized alpha and the tracking error and the information ratio, we would expect that this portfolio would give you higher alpha, so higher outperformance versus a benchmark of 1.8 versus the 1.2 that the portfolio currently is expected to have. And again, part of that is due to the global equity strategies and the potential higher alpha coming from those strategies. That being said, with higher alpha, sometimes you can have higher tracking error. Again, that's that deviation versus the benchmark. And this portfolio would have higher tracking error, as I mentioned before, and a lot of that would be coming from Lindsell Train, given their benchmark agnostic approach. And then down at the bottom, you can see the upside capture and downside capture ratios. The upside capture ratio improves slightly, so capturing 100% of the upside when markets are positive, but protecting a little bit more on the downside when markets are negative, 92% versus 94%. And again, part of that is kind of adding in that value manager and that downside protection manager of Lindsell Train. We also profiled the other managers here, like a combination of Lindsell, Train, and Rockefeller, and Impacts and Rockefeller. And what you can see here, if you look at the bottom, we think that the results for the Lindsell Impacts would yield better results compared to the other combinations. So just stop here. I still have some more information to go through, but I just want to stop here and see if there's any questions on the managers or any questions on kind of the allocations that we're putting up in front of you. So John, I think I saw your hand raised first.
Yeah, just as I'm new at this, so forgive the question. Just as you move on from one manager to another, are there hidden fees or startup fees that are built in, or is it just a straight move on and keep moving on?
Sure. No, it's a great question. Thank you, John. So for certain managers like DFA, small cap value manager, a mutual fund, there's no fees to move away from that. At times, and I don't know the specifics for J.O. Hambro and Axiom, but these are commingled funds. And sometimes when clients redeem from a commingled fund, there can be a little bit of a charge for that in order to make sure that the rest of the participants, meaning investors in those commingled funds, aren't negatively impacted by a large cash flow. At the same time, if there's a cash flow into these commingled funds, sometimes there's a charge again, just to make sure that all investors in the portfolio are not impacted by that. I don't know the specifics to Axiom and GeoHambro, but that could be a potential, but it's a small amount and it's pretty typical. Trish, you have a question?
Yeah, thank you. I appreciate the balancing act that you have to do. So it sounds like Lindo Train is not a fossil fuel and Impacts is, so that you're balancing. But I'm a little downside cap. Can you just explain
Sure.
last option two, Impacts and Rockefeller, why that isn't that? I guess I don't understand the downside capture percentages.
Absolutely. Absolutely. It's a great question. So let me, there was a first question there. Lindsell Train is fossil fuel free.
Oh, okay. Sorry, I misunderstood. Great.
It's not considered a sustainable manager, a thematic manager like Impacts is, but it is fossil fuel free.
Okay, thank you.
And just to clarify that, they don't have a stated policy to be fossil fuel free. However, this strategy has been around for many, many years and never typically invests in energy because that is not a sector that falls into their investment process. So the likelihood of this strategy having fossil fuels is extremely small.
Okay.
In terms of the downside capture, so you're 100% correct, Trustee Riley. The downside capture is better for Lindsell Train and Rockefeller, meaning if markets are down, this option 2 Lindsell Train Rockefeller portfolio would be down a little bit less, right?
Mm-hmm.
So if the markets were down 10%, this portfolio may be down 9%.
Yeah.
Okay, but it's not significantly less compared to this.
Yeah,
And we're trying to balance, we want to make sure that we still capture on the upside. And so you can see that we're still capturing 100% of the upside when markets are doing well, whereas we would kind of be reducing the upside a little bit with the Lindsell Rockefeller example.
And the Impact Rockefeller, same deal on the downside capture.
Exactly.
Okay.
Exactly.
And can I just do a quick follow-up on at this rate, what we clearly have an obligation to the board to meet complete fossil fuel by 2030. How are we doing?
Yep. So I'm going to go to this page here, which will show you, Trustee Riley.
Thanks.
So here's all the investment managers, and Impacts and Lindsell Train are here in the middle of the mix. And so if we focus on the left-hand side of this chart, this is where the fossil fuel exposure was. If you look down the dark blue, at the end of estimated at the end of the first quarter. So about $5.1 million of exposure and 1.3% of the total portfolio's assets. If we went with option 2, you would now reduce your exposure by roughly $2 million to have $3 million of exposure and 0.8% of the total MIPS assets. In addition to this, Trish, we are going to be talking about Newton Global Real Return and reducing their exposure. And that would, again, reduce it by another $1 million. So we'd be down to about $2 million of exposure and about 0.5% of the total portfolio in fossil fuel. So a significant reduction down, leaving the only fossil fuel exposure with your fixed income managers, Common Fund, BlackRock, and Bain, and then some with your equity hedge fund manager, Lighthouse. So quite significant movement down.
Great, thank you.
Yeah. Jim, do you have another question?
Yeah, sorry, yeah, just tacking on. So it sounds like as far as the fossil fuel mandate toward 2030, it sounds like it's achievable and they're on track, first of all. And then just the other quick question, you provided us with the strategy level fees for the new funds. How do they relate to the old ones?
Absolutely. Okay, so I'm just gonna, so Lindsell Train is 53 basis points, and that is actually, NEPC does receive a negotiated fee for our clients. Their stated fee is 60 basis points, so a little bit lower fee. And this would be a commingled fund vehicle. Impacts, we would go into the mutual fund vehicle at 91 basis points. They do offer a separately managed account, but with a separately managed account, there would be additional custodian costs as well. So net, it's a little bit easier to go into the mutual fund. So if I flip forward to this page, DFA, they are actually a very low cost fund, about 29 basis points. So that's a fund that has a really good fee. However, J.O. Hambro, 98 basis points, higher than both Impacts and Lindsell. Axiom is 95 basis points, again, higher than both of the Lindsell and Impacts. And then Aberdeen is 1.1%, so significantly higher. So net, you're probably having a slight fee improvement on this portfolio. And I can follow up with the actual specific calculations if that's helpful.
No, thanks for that. Just saying, it sounds like it's close. So.
Trustee Riley, do you have another question, or is that from previous?
I apologize, it's from previous, sorry.
Okay, no worries. No worries. Okay, any other questions before I hit on a couple other items?
Hi, Kelly, this is Matt. I actually do have a quick question. Sorry, I wasn't able to figure out how to raise my hand. I see it now.
No worries.
I think you had said that the way that these things would be adjusted by, it looks like increasing things like Silchester, for example, that our overall asset allocation would remain about the same. Am I correct in my understanding there? So relative allocation of, say, U.S. large caps, of U.S. small caps, of foreign large cap, foreign small cap, generally the same.
Exactly.
And
Exactly. And on this page 119, Matt, I'm not sure if this is helpful for part of your question, but we did model the current asset allocation and then what the option 2 asset allocation would look like in a beta context based on our capital market assumptions. And down at the bottom, you can see essentially no change. Most of this is rounding 5.7 to 5.6 and 12.6 to 12.7 in terms of kind of, the expected return going forward.
Thank you.
And I didn't mean to interrupt you. Did that help answer your question, or do you have additional questions?
Yeah, no, it did. My other question was just like the general mix of active versus passive strategies. It looks like we'd be tilting a bit more towards active strategies with the shift, especially with the decrease in the fossil fuel free S&P fund.
Yep, that's 100% correct. Definitely tilting more active. But from our perspective, tilting more active in an area where we think more value can be provided to the managed investment pool with these global equity strategies.
Thank you.
Just a couple other things I wanted to point out. Alpha correlation. So when we look at all the managers in the portfolio, what we do is kind of strip out their alpha. So their return essentially above the benchmark. And we kind of see how the managers' alphas react to each other over a long time period. And the purpose of this chart, just to show you, is we want managers that are negatively correlated. Some managers will do well in down markets like Lindsell Train. Some managers will do well in more up markets like Impacts, and you combine them all together to get a portfolio. And so overall, what I wanted to show you is that all the alpha correlations are moderately positive or negative. The only positive numbers highlighted here in red would be J.O. Hambro and Axiom, which we're recommending termination if you select this option 2. And then Rockefeller and Impacts, which is another reason why we're not recommending that portfolio of those 2 managers combined. But all the other managers in the portfolio, some nice correlation aspects to it. We showed some performance comparison for the managers that we're recommending. If we focus on Impacts and Lindsell Train, what you can see is over the last 5 years, Impacts has done better than Lindsell Train, again, participating more in the up markets. You can see some of the down markets here, like 2022, where Lindsell Train outperforms the benchmark. Years like 2020, both managers do relatively well. And that was a difficult year. If you remember the beginning of 2020, a sharp downturn, and that we recovered from that. And then years like 2018, Lindsell Train, again, does much better than Impacts in those down markets. They were actually positive 7% when the market was down 10. So as I was talking about tracking error, these are the types of numbers that you can expect going forward. Pretty significant deviations from the benchmark. The hope and the goal here is that paired together, overall, will achieve alpha above the benchmarks. So let me just stop there and see if there's any questions and how the committee is feeling about the recommendation that we have to go with option 2. If there are any concerns with it, I can move to the rest of the presentation, whereas if you didn't want to go with option 2, I can talk about a different manager to add into the portfolio to just replace Aberdeen Emerging Market Equity and kind of what that portfolio would look like. John?
How long would you expect to hold when you change managers? I mean, do you give them like a 3-year period, 5-year period? What's your hold period? Just to give them to see how it trends.
Sure. So prefer definitely 3 years. 3 years, you can start to see kind of, you know, a few calendar years there. 5 years is more of a full market cycle. That's just for performance. If there's any changes to team or changes to their strategy, that's a whole different story, and we'll have some due diligence announcements on that. But for performance, really over 5 years is a good starting point to assess them. Any other thoughts from the committee on kind of where we should path forward from here? Would you like to discuss option 2, or would you like to see some more information on some other options that are out there?
Ellen, why don't you summarize? So you have 2 options here, done a very good job going through option 2. Is there a reason for the option 1, or should we just be looking at option 2? I guess.
Sure. So I will go through it real briefly, Kelly, and just to give you some highlights here. So the first thing I'll start with is emerging market equity. So let's just replace Aberdeen. And so you'll see here that our recommendation, after looking at a number of preferred managers, that we would recommend replacing Aberdeen with ABS. This chart here shows your current target asset allocation. Again, assuming no changes, we're not going with Lindsell Train, we're not going with Impacts. If we just replace Aberdeen 5% with ABS at 5%, you can see the return statistics improve, the volatility goes down, the alpha up, you know, better upside capture, better downside capture. So ABS, just as a high level, is a manager. It's almost like a hedge fund of fund manager for emerging market equities. So what they do is they try to find sector specialists in the emerging market space, you know, focusing on China, focusing on India, focusing on financials, and kind of group all those managers together. So it's a fund of fund like approach, and typically holds about 400 to 600 holdings. In terms of fossil fuel exposure, it is not fossil fuel free, but it has less fossil fuel exposure than Aberdeen. So Aberdeen currently has about, let's call it 4% in fossil fuels, and ABS has about 3%. So there still would be fossil fuel exposure, but to slightly a less degree. We then show here the performance on a trailing basis for Aberdeen versus some of these other managers that we considered. And we took our focus placement list and we said, okay, let's not focus on very deep value emerging markets or deep growth emerging market managers. Aberdeen was a core manager. Let's just look at other core managers to replace them. So that's how we got down to this list here: ABS, Axiom, and Fidelity. We profiled their results against Aberdeen, and you can see that ABS is clearly the standout over the last 5 years. And then even within the calendar year period, you can see that they're a standout versus some of these other managers. In terms of fees, you can see that the fees are much lower. You can choose a 45 basis point plus a 10% performance fee. So that would be for outperformance over a benchmark. You would pay 10% performance fee on that, or a straight 75 basis point vehicle, which is much lower than Aberdeen at 110 basis points. So they also win from the fee perspective as well. We then, now I'm going back to the first analysis that Matt and I were doing, which is option one. That's why it was called option one, because it was our first option that we started to explore. And so here is just hiring one global equity manager to complement Walter Scott. So either Lindsell Train, either Impacts, and either Rockefeller. And in this analysis, we've just also placed in ABS as a replacement for Aberdeen. Within this, one of the reasons why we didn't recommend this was just some of the statistics below. But if you were to go with this strategy, Impacts look like a better approach in terms of upside and downside. However, this would not reduce your fossil fuel exposure significantly because you still would be maintaining managers like DFA, J.O. Hambro, and Axiom, and then the exposure from ABS. So again, we thought option two was a better way in terms of from a risk and return perspective, an alpha and tracking error perspective, and then also, hitting your divestment goals, making better progress towards your divestment goals, I should say, and reducing the exposure.
Thank you. So, quick question, and I don't know who to ask this to. I'm going to throw it out in regards to Robert's rules. If we're going to go through option one or option two, do I read the text of the proposed resolution and have the committee either make a motion? How do I read both of these and we vote on each one? Or do we just go with the consultant recommendation, which seems to be, if I'm going to put my opinion in, the way to go on option two?
Seems to me, Kelly, you could just read it as option two.
Okay. All right. Kelly, are you finished with your with reviewing tab 3? Do you want me to move this to resolution?
I am finished. Unless there's other questions, I'm happy to answer them. But that was the presentation and kind of the reasons why we were recommending option two, which was to hire Lindsell Train and Impacts and terminate those 4 managers that I went through.
Okay, great presentation and great option. Anybody in the committee meeting have any questions, comments, concerns? Okay, hearing none.
I see a question,
Oh.
Trustee Martin, from John.
Oh, okay. Trustee Moore?
Just question for Jim. As our consultant in residence, are you comfortable with this as well? Just weighing in on your own opinion.
Yeah, I personally kind of bought into all of the smaller pieces. Frankly, there were a couple that were a little fuzzy even for me, but I especially like the correlation analysis that was done with the combinations that they put together. I think that overall it's not it's a way of getting closer to the objective, and it doesn't seem to have a whole lot of drawbacks either from upside capture, downside capture, expenses, overall portfolio construction. So relatively comfortable there.
Okay. So another question. Should I read option one for the people that are listening to the YouTube video and read option two, or should just propose option two?
I think it was a good idea, Kelly, that you had option one reviewed. So I think it's in the record that it was reviewed, and it's fine to just go to 2.
Okay, so just go to 2 at this point. Okay, so any other questions, concerns? Hearing none, I'll read the text of the proposed resolution that the Board of Trustees, acting through the Investment Committee, approves the following investment manager and asset allocation change. Hire Lindsay Train, Global Equity and Impacts leaders for approximately 10% of the total portfolio assets. Terminate DFA, J.O. Hambro, Axiom in Aberdeen. Approve the new asset allocation reflective of the above changes as detailed on page 10 of the presentation. Can I have a motion?
So moved.
And so moved by Chair Riley.
I'll second it.
Second by Trustee Moore. And Beth, Clerk of the Board, I'm going to transfer it to you for a roll.
For Trustee Martin,
Approve.
Trustee Riley,
Yes.
Trustee Moore,
Yes.
motion carries.
Thank you. And Kelly and Matt, back to you for the Global Asset Allocation Manager recommendation.
Okay, great, thank you. And I just want to stop here. I do see Catherine. Hi, Catherine, and Philip. Hi, how are you? So just for the investment committee, we do have Catherine and Philip from Newton that have now joined the Zoom call. I'm going to start the presentation and go through the reasons for the recommendation, and then I'm going to turn it over to Catherine and Phil to talk a little bit more about, from their perspective, how they would implement what we're recommending to the investment committee. So just to start here on page 144, as you know, you approved a fossil fuel divestment policy in April of 2022. And as we just reviewed with the global equity portfolio for the managed investment pool, NAPC continues to find ways where we can reduce fossil fuel exposure for you to meet your goals by 2030. Specifically, we started having conversations with Newton. And as a reminder, Newton has the Global Real Return Strategy. It is in mutual fund format through a BNY Mellon mutual fund. And it is across all 3 portfolios, the MIP, the pension, and the operating fund, in total investments by the system into this mutual funds, about 44 million. As you all are aware, you cannot tell a mutual fund to divest from fossil fuels, right? You're beholden to the prospectus and the investment process of that mutual fund. However, for a separate account, you can provide an investment manager with certain guidelines. And so Newton has graciously offered to run a separate account for the Global Real Return Strategy, which would divest from fossil fuels, and they'll talk a little bit more about that. We did look at Newton's sustainable version of this Global Real Return Strategy as well. One of the reasons why I'm not recommending that today is because, one, it's only really launched in the UK. They certainly could run it over here in the US. But secondly, it does a little bit more than kind of reduce fossil fuel exposure. It also looks at sin stocks and other types of exclusionary type investments. And so we want to focus mostly on your goal, which is to reduce fossil fuels. In terms of fees, on this page, you can see you pay about 86 basis points in the specific mutual fund ticker. Newton has offered to run the separate account for a portfolio with $50 million or less for 65 basis points. So you'll see a reduction in investment management fees. However, as I had mentioned earlier in the global equity section, there is an additional cost to your custodian, to the system, for running a separate account, because there's a mix of domestic equity securities, international securities, and emerging securities. There is an additional cost. So we estimate that you'll save about $92,000 annually on the fee savings for the product, but have to pay about $80,000 annually to the custodian to run that product. So net, there will be a fee savings, but just wanted to put that forth to the committee. One of the things that Newton worked on and that I've discussed with them is just, how would this impact performance of the strategy? As Matt walked through earlier, performance of the strategy has been strong versus benchmark and versus peers. And if we excluded fossil fuels, what would that mean for the performance going forward? Now, we certainly, don't have a crystal ball on what that's going to say for the strategy going forward. But if we did a back test, and Newton did a back test, that over the last 10 years, excluding these stocks that we've listed at the bottom of page 144, which is the fossil fuel exposure stocks, would have resulted in a performance of 7 basis points lower. So the performance impact on a look-back basis has been relatively small. So I'll stop there and see if there's any questions on the recommendation that we would be moving from the mutual fund version to a separate account version, which would exclude fossil fuels, before I turn it over to the Newton team. And I should have mentioned, in addition to Catherine and Phil, we also have John Ritz that has joined us from Newton. Sorry, I missed you in the beginning, John. So I'll see if there's any questions.
I apologize for asking the same question over and over again, but on the fee level, what you're basically saying is that relative to the mutual fund, the SMA, even though it has the additional custodial cost, is a little bit less. And do you see that as kind of being linear as you go into the future, as the account grows in value, that should maintain its fee advantage over the mutual fund strategy?
Exactly. Yep, that's exactly right, Jim. And here on this page, the separate account, when assets get above 50 million, the annual fees go down to 60 basis points. So as assets grow, there will be additional fee advantage.
Great.
Trustee Riley, is there a question?
Jim actually asked my question, but I'm just curious, Kelly, when we talked about this whole initiative, I understand that there's measures that test who's in fossil fuels and who isn't. So are there mutual funds that are fossil free? Do we know?
In this specific space, which is global asset allocation, where you have a mix of global equity and global fixed income, there could be, but I'm not aware of any. There's none on our preferred list that are fossil fuel free.
Okay, so this is basically a real step in the direction toward divestment by using the same company we know and trust. Great.
Exactly. And similar, thank you for the question, Trustee Riley. So if you remember Silchester, right? Silchester is an international equity manager. It's one rated at NEPC, and they came out with a fossil fuel free strategy. So again, similar, let's find great managers who are rated highly at NEPC and start there and see where we can get the fossil fuel free exposure from.
Great, thanks.
Yep. Okay, so John, Philip, and Catherine, we have your presentation here. I'm driving the screen here, so just direct me where you'd like me to go. And just so the investment committee knows, the Newton team is just going to remind you of who Newton is, remind you of the process, and then give you an update of kind of how that process would change if you did select to go with a separate account and provide guidelines on fossil fuel free investing. So I'll turn it to you, John.
Yeah, thanks so much, Kelly. And thank you all from the university. We really appreciate this opportunity to work with you on this journey. I'll just cover off quickly on the page that speaks to who Newton is. But first of all, I just wanted to say thank you for the relationship, which dates back to 2016. We view this as a great partnership, not only with the University of Maine, but also with NEPC, and we're thrilled to work with you to continue on the divestment of fossil fuels. To step back, our firm is a global firm. We have offices in London, San Francisco, New York, and Boston. We have size and scale. We're about $110 billion in total assets. And if you look at the left-hand side of the page, you'll see that our active multi-asset business has about 50% of the assets. So it's large and scalable. And the assets within that group are broken out into multi-asset solutions, which is primarily systematic strategies. It's about 17 billion. And then the global real return strategy is about $8 billion. If you look over to the right-hand side of the page, you can see we have a very diverse book of equity business. It's spread across a number of strategies which are diversified, and that's about half of our business. So I guess with that, I'll just stop and see if there's any questions. But again, we're absolutely thrilled to continue. And as Kelly mentioned, we've structured the fees so that as the assets in this portfolio grow, you'll get better pricing. And we're hoping that in 100 years, the assets in this portfolio will be significantly higher, and that Maine will enjoy a much better fee rate. And with that, I'll stop and turn it over to Catherine and Phil. Thank you very much.
Great. Can I just check you can all hear me clearly? Good. So both Phil and I have been involved in the real return strategy for the past 16 years. Phil is a portfolio manager on the strategy, and I work on the desk in an investment specialist capacity. So we've navigated many different market conditions. Here you can see the team. It's a very well-established team with very low turnover. 3 of the individuals have actually been involved in the strategy since its inception. And here you can see the full team made up of 9 individuals drawing on the skills and expertise of the broader firm. And, you know, as I've mentioned, you know, we've successfully navigated different market cycles together. And it would be the very same team managing a fossil fuel-free version of the strategy. I'd like to draw out 2 members of the team, but I could create a similar picture with any member. So Matt Brown is our equity specialist. He has a real passion for analysing companies, and he works closely with our global sector analysts to get under the skin of different companies. In a similar fashion, Phil here has a deep knowledge and interest in ESG, and it's also an area that he's passionate about. I mentioned the fact that we're drawing on the other resources that Newton has, and it's worth highlighting the fixed income team, which gives valuable input on the bond holdings in the fund, and also the responsible investment team, which of course is very pertinent to a fossil fuel-free version of the strategy. And in fact, our credentials in that area are very strong. They go right back to when we were first founded in 1978. We do adhere to strong principles of being active stewards of our clients' capital, and we have a dedicated responsible investment team. Each member of the team within our responsible investment group collaborates and engages with industry bodies on an ongoing basis, as well as engaging with companies alongside the portfolio manager. So what are our credentials on the responsible investment side? Well, we're a signatory to the Net Zero Asset Managers Initiative. That has an interim target of 50% of our financed emissions being covered by credible transition plans by 2030. And we were also an early adopter of the Task Force on Climate-Related Financial Disclosures. And that's a leading global framework for the reporting of climate-related information. But of course, you know, it's important that we practice what we preach. So as a firm, we've also taken a number of steps to reduce our own carbon footprint. So we're using renewable energy, we're recycling waste, and we're also upgrading our building efficiency. So ESG practices are very much built into our culture, and they are an important input in our investment process, which Phil will go on to talk about. They're also reflected in our clients' solutions, such as the one that we're proposing to you today. So turning to the next slide, I just wanted to refresh you on what you currently have. Real Return is a multi-asset, unconstrained portfolio of directly invested holdings. The Sterling strategy was launched in April 2004, and we have a really established, strong pedigree since our inception in 1978. It is an outcome-based strategy, so there's no benchmark. We aim to achieve cash plus 4% gross of fees over rolling 5-year periods. And we're aiming for volatility to be somewhere between equities and bonds. The way we do this is through 3 key principles. The first is traditional security selection, so based on our fundamental bottom-up approach. The second is asset type flexibility, so we're moving nimbly between asset classes based on our view on our sort of judgment call of the backdrop. And the third is an emphasis on capital preservation. And in terms of the client experience, what we're trying to generate are decent long-term returns with reduced volatility. So I've covered now the team and the strategy, and I'm going to turn to Phil to give you an insight into the investment process.
Thank you, Catherine. And Kelly, if we could have the next slide, please. Thank you. So, so I'll give you a very quick refresher, just a reminder of what the process that we're using to manage the assets that you currently have with us. It starts at step 1, and Catherine's just said this. So what's the performance objective, cash plus 4? That's an upwards only, reasonably ambitious objective, but with that lower levels of volatility, and particularly capping the downside in big market moves. But it's really at stage 2 where the process starts. And this is by using themes to interpret the backdrop. We're trying to simplify the backdrop down to something that we can really understand the investment implications of, and not get caught up in all the short-term noise. So give you an example. Natural capital is one of the themes that we have had for a long time at Newton. And originally that was observing how the externalities that companies were producing, whether that was emissions, pollution, wasn't being properly captured, and yet regulation was changing, and that was going to be a risk. But that theme's evolved over time to actually capture a lot of opportunities as regulation has stepped up, as remediation efforts have had to be put in place. There are a lot of companies offering the solutions to today's challenges, and those present investment opportunities. So very simple example, themes, very observable, but they help to guide where we look for our investments. And that brings us to stage 3. So all of the people that Catherine talks about, all of the teams of analysts, equities, credit, commodities, fixed income, currencies, we're all working together on this same thematic backdrop, same outlook, trying to whittle down the vast global opportunity set to a relatively small number of ideas that we might actually consider investing in. And those are distilled down into a recommended list by those analysts. So that's stage 3. Stage 4 is, having worked alongside them, it's for us as a team to really understand the characteristics of each of those individual investments. You know, in what environment is that investment likely to work and produce a good return? In what environment would it be more challenged? What is it likely to be correlated with? How does it compare with all the other options that we have? And ultimately, stage 5, bringing that together into a holistic portfolio. And just very, very briefly zoom in on stage 5. So if we go to the next slide, please, Kelly. Now, this is a conceptual representation of how we think about building the portfolio. It's got 2 parts. It's got a return-seeking core and a stabilizing outer layer. Now, the return-seeking core is where we expect to deliver the bulk of the long-term returns for you. These will be relatively long-term investments. And around that, we build a stabilizing outer layer. This will be a lot more tactical in nature. The idea in the outer layer is to dampen volatility and offset some of those big negative market events. Now, as Catherine alluded to on one of the previous slides, one of the key tenets of the strategy is flexibility. We are unconstrained. We're not following a benchmark. And so when we're in good times, you can expect the core to make up the majority of this strategy. However, when we start to get into more difficult market conditions, that's when we start to bulk out the stabilizing outer layer of the portfolio. So it's quite a unique and flexible approach to global asset allocation. Now, that is all a recap of what you currently have. If we, what we were asked to come up with for you was by Kelly and NEPC was how can we help you with the fossil fuel divestment objective? And as mentioned, what we proposed was actually to do a customized portfolio just for yourselves. It will be based on exactly the same strategy, exactly the same team running it. The only difference will be applying a fossil fuel exclusion. Now, in practice, how does that fossil fuel exclusion work? It is based on revenues. We are not going to be including, we will be excluding any companies from the investment universe that engage in the extraction of fossil fuels. And that's oil, unconventional oil, that's gas, unconventional gas as well, and also thermal coal. Now, the exact criteria will be a 10% revenue threshold. So any company deriving more than 10% from the extraction of fossil fuels will be excluded from the portfolio. Now, we already have all of the back office solutions in place to implement this. In fact, we already have a number of live portfolios, sustainable portfolios, which implement this criteria amongst other criteria that they have. So it's a very robust system, and we're very confident in that. And in terms of practice, what will it mean for the strategy? Kelly talked about the back testing that we did. The proportion of the portfolio that we've historically had in fossil fuels has varied over time, but on average been relatively low single digits. And as such, the performance differential is actually very small, and we would expect it to be very manageable on an ongoing basis. So we're very excited about the prospect of being able to work with you on this project, and we're very confident that we have the setup in place to be able to deliver it for you.
Great. Thank you, Philip and Catherine and John. Really appreciate it. I'd just like to open up to the investment committee, see if there's any specific questions for Newton that they could answer for you. Okay, hearing none. John, Philip, and Catherine, thank you so much for your time. Thank you for working with me and NEPC on coming up with this solution for the University of Maine system. We're going to continue on with our meeting, and then I will be in touch with you on if or any next steps on this idea.
Yeah, from all of us at Newton, we hope you guys have a great day and a great meeting. And thanks again for the opportunity to work with you as partners. Have a great day.
Thank you so much.
Thank you.
Thank you.
Thank you.
Thank you.
Okay. Trustee Martin, I will turn it over to you. Just before I do that, as a reminder, exact same strategy that you're in today, highly rated manager, NEPC. Again, just removing the fossil fuel exposures, and the way to do that is through a different type of investment vehicle, being a separate account compared to the mutual fund today. So generally, exactly what you have today, just removing those fossil fuel exposure, which is relatively limited in the strategy to begin with.
And Kelly, you said they were doing this for us, but I assume this becomes a product that's quite marketable for them going forward. There'll be others who do the same.
Sure. So Newton, for their larger clients, that have assets, 50 million or above with them, they do custom solutions like this already, all in separate account type vehicles. They do have the sustainable strategy. As I mentioned, it's really only launched in a commingled fund over in the UK. Which can be launched here in the US if they had an investor. But again, that eliminates more than just fossil fuels. I do think that over time, if there is enough interest in these types of strategies, they would open up a product or could consider opening up a product similar to this and more of a commingled fund or mutual fund format. But today that doesn't exist. So right now they're just doing it in a custom separate account framework for clients with enough assets. And just so the whole committee knows, it's going to be one separate account if you elect to move forward. And then what BNY Mellon then does is unitizes it. So a portion of the MIPS assets get the separate account, a portion of the pension, because remember the pension's only 18 million in total assets. So, and then a portion of the operating fund would get a portion of the one separate account that's being run. So we worked with BNY Mellon on the structure of that as well, which they can accommodate.
Thank you. Thanks, Kelly and Matt, for your knowledge, expertise, and guidance in navigating these markets, and really especially for helping us align with our mandates and our charge for divestment. Really appreciate your work on this. And it brings us to tab 4. The Global Asset Allocation Manager recommendation. So I'll read the text of the proposed resolution that the Board of Trustees, acting through the Investment Committee, approves the following investment manager. Switch from the BYN Mellon Global Real Return, DRRYX strategy to Newton Global Real Return separate account for the MIP pension and operating fund. Can I have a motion?
So moved.
So moved by Trustee Moore, and second.
Second.
You're on, Trish. There we go. And that was seconded by Chair Riley. Clerk Beth, can I ask you to take a roll, please?
Yes, Trustee Martin,
Yes.
Trustee Moore,
Yes.
Trustee Riley,
Yes.
motion carries.
Thank you. Kelly and Matt, thank you for your work. I really appreciate it, and have a nice Memorial Day and beginning of the summer.
Thank you so much. It was great to be with all of you. Thank you for your great questions today. Really appreciated the time.
Thank you
Okay.
for all your work.
Thank you. That was good.
Take care.
Bye, everyone.
Moving, Mike, I see you. Barry, yep, right there. So without further ado, I'm going to pass the meeting over to Mike and Barry to discuss the defined contribution plans and the quarterly review.
Okay, great. Well, thanks, Trustee Martin, and good morning, everyone. It's great to see you. Barry and I are going to divide up the presentation here. We actually have quite a bit of material to get through over the course of the next 50 minutes or so. So the quarterly review, I'm going to start off with a real streamlined version of the typical quarterly review. Then I'm going to hand it over to Barry. He'll share his screen and talk about a fee benchmark, a share class review, and a couple of other items as well. So as always, please ask any questions as we go through this. And again, I'll go through it fairly quickly, but if you feel like I'm rushing it or you want me to spend additional time on any item at all, please don't hesitate to let me know. Can you verify, Trustee Martin, maybe that you can see my screen? Okay.
Yeah, we can see it well. Thank you, Mike.
Okay, thanks. I apologize. I think there was a little bit of a mishap with the materials. All the materials may not have ended up in your board packet. So we're going to make sure to get those out immediately following this meeting. And I apologize for that. We do have a number of topical spotlights at the start of the deck. I'm really not going to spend much time at all on these, but I did want to point out that they are in there. We go through these in detail with Tracy and Trustee Martin before the meeting. And if there's anything that they feel like would be of particular interest to the group, we certainly would focus on them. In this particular case, again, these are really more informational. Barry is going to talk along with Tracy about the small balance force out of under $7,000 and maybe touch upon this auto portability feature. But again, I don't want to spend a lot of time on that at this point. And then finally, we do have a slide in there on Roth in-plan conversions. This is something that's starting to get more attention from some of our clients. We frankly haven't added this feature to a lot of plans, but we're starting to see more people be interested in this. So I wanted to point that out. Essentially what this is an opportunity for people who have their money in the traditional pre-tax savings account to convert it over to Roth in the form of an in-plan conversion. There's a lot of kind of complexities to this. It is a taxable event. We don't see a lot of people actually taking advantage of this, but there has been a fair amount of interest. I'm not sure, just quickly, is Jim Bradley, I couldn't see if he's on the line, but I'd be curious if you see, Jim, if you see any of the people that you talk to, talking about in-plan Roth conversions these days at all. Sorry to put you on the spot, but I'm just really curious.
It's all right, Mike. I wouldn't expect anything else. Relatively small number of people within the university plans could be because we don't bring it up a lot because it's not an option, and we do see a bigger portion of our private sector 401k plan participants asking about it. So I suspect if it became an option, it might have a little bit more traction, but right now a very low percentage.
Okay, thanks, Jim. And that's what we're finding is that even people who are interested, when they find out that this is a taxable event and those taxes have to be paid outside of plan assets, they kind of pretty quickly move on and say, well, maybe that doesn't sound like that good an idea after all. I know that you've already had probably some pretty detailed market updates through NEPC. So again, we'll provide just a streamlined market commentary, but I can't help but pause on this page and point out that we're coming off certainly an outstanding year in 2023. All asset classes were up with the exception of commodities, which was about the only place to make money in 2022. But all asset classes were up last year, and we really continued right into 2024. If you look at the quarterly performance on this page, you can see U.S. large cap stocks up double digits through the close of the quarter. Through yesterday, that number is up closer to 12%. International equities at 5.8%. That's the EAFE benchmark, EAFE benchmark. That number is up closer to 8% as of yesterday. And bonds last year did rally up 5.5%, but continue to be in the negative on a year-to-date basis through yesterday, and you can see through the first quarter as well. All that performance, as you'll see in a minute, is reflected in growth and plan assets really across the board, something that we're really thrilled with coming off a very difficult 2022. We continue to see this rotation to growth. So, 2022 was really more of a value-oriented year. 2023, we saw this rotation right back to growth. Those what we used to call the FANG stocks, Facebook, Apple, Netflix, Google, all of a sudden are being called the Magnificent Seven stocks, and you're adding companies like NVIDIA and Tesla in there as well. They continue to really drive the market. The more kind of overweight you are, large cap growth, and specifically the more overweight you are in those stocks, the better your portfolio has performed. So you look at like your Harbor Capital Appreciation Fund, that's the university's large cap growth option. That closed up, I should say that year to date is up almost 15%. And you compare that, to the S&P that's up about 12, and coming off a year last year where it was up actually 53%. So making up for a lot of that downturn of 2022. It's really kind of if you're looking for one fund to understand what's going on in the market, it's a really good fund to look at because of that overweight position in those Magnificent Seven stocks, the large cap growth nature, and then also, kind of the market rotations. You can see how it struggled in 2022 and really bounced back in 2023. Jumping all the way ahead to the asset pages, you can see page 21 is just a snapshot of your fund lineup. But we continue to think that you have a really well-structured fund lineup. All the critical asset classes are covered on both an active and a passive basis. You're using the low-cost, well-diversified, professionally managed Vanguard target date funds as your default investment option. Again, we just continue to feel really good about the structure of your program. In addition to that, we feel really good about the underlying funds that are making up the program as well. You can see we did highlight on this page the Euro Pacific Growth Fund. That's the American Funds Foreign Large Cap Blend Fund. That fund continues to be marked for review. Similar to last quarter, that is not a fund that we really have any concerns about at all at CapTrust. If you look at the reason that that fund is marked for review, I mean, it's really essentially one challenging year that the fund had when emerging markets were really down, and that's a fund that is overweight emerging markets. So no concerns at all. In addition to that, just to point out, I always like to point out that you folks are in the least expensive share classes across all of the different funds that you're offering as well. And you moved to a flat fee payment methodology as well. I think that from an overall fiduciary management perspective, the team at University of Maine System and this group specifically has really checked all the boxes, and the plan has continued to evolve with the market and I think get stronger. We continue to be hopeful that the collective investment trust or CIT legislation will pass in 2024. If that does happen, we really at CapTrust have a number of collective investment trust options teed up for your plan that potentially could save participants literally tens, if not hundreds of thousands of dollars in investment expenses. And that's something that, we'll certainly keep you posted on. The most recent version of the regulation did recently pass the House and is with the Senate. And so there's a little bit of cautious optimism that it might get actually voted on this year, which again would be really good news for the University of Maine System and specifically plan participants. You can see assets really continue to grow. We're just below, as of the close of the quarter, just below that $2 billion threshold, which is obviously great. And you can see at the bottom of the page, you still have some what are called legacy frozen assets out there. But for the size of your organization and the number of participants that you have, that's really a pretty small number compared to what we see in other university systems. So, certainly no concerns there at all. And then finally, from an asset allocation perspective, you can see the breakdown of plan assets, and you have really an extremely well diversified plan. About 30% in capital preservation. That would be that TIA traditional account. And then the balance really diversified across target date and then the core group of mutual funds. You do also offer a self-directed brokerage account with about 2% of assets in that, relatively small amount, but I think a nice feature for people who are maybe looking for alternative asset classes that aren't part of that core fund lineup. Really great place to get access to that is through that self-directed brokerage account. And then highlighting here, again, I'll talk a little bit more. Euro-Pacific growth is marked for review, and that represents about 2% of overall plan assets. So I'm going to jump all the way ahead to the scorecard, and you can see, for the most part, we have a pretty clean scorecard this quarter. We do have the one fund, Euro-Pacific Growth, marked for review with a score of 78. On a year-to-date basis, EuroPac, as we call it, is up about 16%, and it's in the top quartile. So I mentioned the EFI benchmark up about 8%. That fund, top quartile peer relative performance, coming off a couple of years in a row where it was either below or just at the 50th percentile. And really, you have to go all the way back to 2021, where the fund had a poor year. And that's really the year that's driving that 3-year performance down. But that will start to rotate off, and hopefully we'll continue to kind of have strong quarter after strong quarter. I think realistically, we could see this fund back in good standing as soon as next quarter. The CIT, or Collective Investment Trust version of this fund, which would be a lower cost version, is actually already in good standing with a score of 82. Harbor Capital Appreciation, you can see the risk-adjusted performance is below just slightly below the 50th percentile, but peer relative performance above the 50th percentile. And all the other qualitative and quantitative categories are solid with an overall score of 91. And again, that's a fund that's coming off a really, really strong year and having a very strong year in 2024 as well. So certainly no concerns with Harbor Capital Appreciation. Interesting there, a couple of years ago, the lead fund manager did rotate off that fund. And so we were keeping a close eye on that. The team approach that they've built over the years has really just seamlessly taken control of that fund. and has had no issues whatsoever, has actually had incredible performance over the last couple of years. And then finally on this page, you can see JP Morgan Equity Income is scoring an 81. That fund is actually back in good standing with a score of 81. It had very briefly slipped into the marked for review category. The 3 and 5 year performance of the JP Morgan fund is slightly below the 50th percentile, but the fund is actually behaving the way we would expect it to. This is a deep value fund. And if you look at kind of the way that this fund is managed, you're generally speaking going to get really good performance in more value-oriented markets and more downside protection in down markets and some lagging performance in up markets. That is really exactly what we're getting here. JP Morgan Equity Income in 2022 closed out the year in the top 20th percentile, so beat 80% of its peer group, and then lagged in 2023. So markets rotated back to positive, back to growth, away from value in 2023. And so they struggled in 2023 as a result of that. And then so far year to date, the fund's up a little bit under 8%, down in the 60th percentile. So kind of making up some of that lost ground in 23. The long-term performance has been very sound. We really like the manager team. They did have a manager departure last year, but we were very comfortable with that. There was a clear succession plan in place, and we continue to really like this fund. And again, not really have any concerns about it at all. And then jumping ahead to your more aggressive asset classes, you can see continued strong performance here. If you're scoring based on our scoring methodology, if you're scoring in the 90s, you're really looking at top half to top quartile, peer relative and risk adjusted performance. And we're getting that across your MFS International Value and both your Victory and MassMutual Small Cap Value and Small Cap Growth. So certainly no concerns there. Any questions on the actively managed funds before I shift to target date and some of the other investment options? Yeah, Jim.
I just put one really quick one in on the collective investment trust legislation as it goes through. From a committee standpoint, what would we be kind of expecting you to come forward with if that did pass? Do most of the retail mutual funds that we're in have CIT versions, or would there be a pretty substantial shuffling of what you're recommending as funds?
Yeah, that's a great question, Jim. And yeah, we would immediately, given the fact that we do have access, a university would have access to lower cost options, we would immediately come back with a analysis of the entire fund lineup. And we are very pro CIT. And so we would recommend across all of the asset classes where CITs exist that we convert over to CITs. The big ones certainly would be the Vanguard Target Date Funds, Harbor Capital Appreciation. Some of your larger holdings do have CIT versions, but to your point, not all of them. And so there are funds that just simply don't have collective investment trust versions. So it would be a bit of a hodgepodge of mutual funds and CITs, but that's fairly common. I mean, in the 401k world, that's a very common, as you know, that's a very common feature that we have in 401k plans. Even large plans, I have a $5 billion client where we still have 3 or 4 mutual funds in there because they just don't have CIT equivalents. So.
But we are seeing also the market being more receptive to creating more CIT versions. Mm-hmm. So we would expect some of the managers that don't have a CIT today would in the future. So as that will kind of come to fruition, we would expect a very detailed conversation on that.
Yeah, that's a great point, Barry. And one thing I should point out is that, one of the issues with CITs, even with large plans, is having enough assets under management in order to access those CITs. At CapTrust, we're actually fast approaching $1 trillion in assets under advisement. And we really use that leverage, if you will, to work with the mutual fund companies to gain access to CITs for our clients specifically. So there are some CIT versions that you only have access to as a CapTrust client, which we're really proud of. And we have a team whose entire job is to just continue to work with mutual fund companies to develop those relationships. Really good question, though. Vanguard Target Date Series, we continue to believe the Vanguard Target Date Series is certainly the top conviction choice in the passive or index-based target date funds. You're getting low cost, professional management, great diversification. The Vanguard series did struggle a bit in the first quarter. And the reason for that is basically their glide path tends to be a little bit more conservative than some of their peers. So if you looked at the glide path, and that's basically that asset allocation of the target date funds, they tend to be more conservative. In addition to that, their strategic allocation is much more globally oriented. And what I mean by that is that they have an overweight position to international equities relative to some of their target date peers as well. Those two things, if you just think about basic market commentary, US markets have outperformed international markets, and the market has been up significantly. So any more conservative position and any position with a heavier weighting to international is going to be a detractor to performance. Again, overall, the funds have performed really well. So we certainly don't have any concerns. I believe that, as a default investment choice, the Vanguard Target Date Series is about as good as you possibly can get. So no concerns there, but it has, those positions have dragged the overall score down just slightly to below 90 to the 87 mark. Vanguard Money Market Tier Traditional Choice continues to be really in good standing and no concerns there. The Tier Traditional yield is up, pushing 6%. So really a nice option for people who are near retirement, who want basically a risk-free investment choice where they can continue to do better than inflation. So really good choice with the Tier Traditional. And then the entire Vanguard Index Series. You can see you're in the institutional version across all of the asset classes here. This would be another example of, where Vanguard has CIT versions, and then there are also a number of other CIT index funds out there as well at even lower costs. And then Tier Real Estate and CREF Stock, we break these out separately as distinct investment choices because they're very tough to benchmark. CREF Stock is really a multi-asset class fund. Tier Real Estate, it really isn't a traditional real estate account. It's really direct investments in real estate. So it's not fair to benchmark it against REITs or the real estate asset class in general. But we continue to feel like those are both appropriate choices in the plan for participants. And then I'll wrap it up with an overall plan score. This score I don't think is hugely meaningful, but I do think it gives you a fairly good indication of the strength of your plan. 93 is a very, very good score. The thing that I really like about this page, though, is it shows you kind of the scoring trends. So you look at a fund like Euro Pacific Growth and you can see where that score started to slip and is ultimately coming back up. Similarly, the JP Morgan Equity Income, you can see that's a fund that was scoring a perfect 100 as recently as the fourth quarter of 2022. And then started to slip, but still in good standing with a score of 81. So overall, I'll just kind of wrap it up and say it was a really good year in absolute terms. I should say a really good quarter in absolute terms, but also I think your fund lineup held up extremely well for the quarter and continues to be really positioned, as we go into now, unbelievably, we start to approach the second half of 2024. So I'm gonna stop, see if there are any questions, and if there are not any, I'll kind of quickly turn it over to Barry, who has a lot of information to share as well. Okay, Barry, I think it's all yours. I don't see any questions.
Right. You see my screen?
Yep.
So the next tab and the item on the agenda is, as you recall, the last trustees meeting, we talked about the raising of the small balance payouts from $5,000 to $7,000. And this is really a practice that's prevalent in the industry. And ultimately, these smaller balances are a drag on the overall efficiency of the plan. And so the trustees tasked us with going back, having some conversations with union representation, looking at the letter that was sent out, improvements on the letter, in addition to how many people that might be impacted for this change. And so a couple pieces of information. As we looked at this, we did feel like there's about 300 or 350 participants at that time. It's always going to be variable, that had between $5,000 and $7,000. So that would increase the amount of payouts to about 350 or so more people. In addition, we had conversations with union representation. You know, that was I felt a really productive call. We made some revisions to the letter to make it clear that if somebody has another University of Maine retirement plan that has more balances in that, they could roll the money into that particular plan and avoid the payout. So that was really a good add to the letter. In addition, CapTrust was able to negotiate a lower fee with Inspira, which is the outsourced IRA provider, from $35 down to $30. So we feel, all told, we feel really good about the trustees, or at least recommending to the trustees that we increase from $5,000 to $7,000 the small balance payout. So I'm not sure, Tracy, if you have anything to add.
Yeah, thank you, Barry. That's a great summary. I just add that Jim McClymer was very thankful for the meeting and the improvements to the letter. He actually commented he had no concerns with this $2,000 increase to the threshold, with a negotiated fees that CapTrust did with Inspira, that's actually cheaper than the fees that those small balance participants are paying with TIA. So all in all, it was a great meeting, and I think that he was supportive of this approach.
So Trustee Martin, do we want to, CapTrust is formally recommending that the trustees increase the small balance payouts from $5,000 to $7,000.
Thank you, Barry, and thanks for the work and the due diligence done on this. I will read the text of the proposed resolution that the Board of Trustees, acting through the Investment Committee, approves increasing the small balance threshold amount to $7,000 effective January 1, 2024. Do I have a motion?
So moved.
So moved by Trustee Moore. Second, Trish, are you out there? There you go. The second from Chair Riley. Beth, I'm gonna hand it over to you to do a roll call vote.
Okay. Trustee Martin,
Yes.
Trustee Riley,
Yes, given the great
Trustee-
outreach to our retirees. Thank you.
Trustee Moore,
Yes.
motion carries.
Thank you, Beth.
Thank you. So the next item on the agenda is, periodically we want to make sure that the fees that are being assessed primarily with TIAA are competitive in the marketplace. If we were following ERISA says you don't have to have the least expensive structure, but is the fee reasonable in the marketplace? So we did an analysis of the TIA fee, and this is a result of that analysis. As you recall, as we're going through this, when TIA prices business, we just talked about the average account balance is really a determining factor, and ultimately what they will assess, because there's a fixed cost to maintain a record on a record-keeping platform. And so the greater the account balance, the more efficient that particular record is. So the 177,000 average account balance, they really look at very seriously when they're looking at their fee arrangement. The other thing that we do, as you recall, a number of years ago, we made the decision to go to a fixed fee arrangement. And with that, all excess revenue, any fund that's sharing revenue, that revenue goes back to individual participants. So at the end of the day, the vast majority of participants are paying the $49 record-keeping fee. I know we have an additional, I think a $19 additional fee for administrative costs, but every participant is paying that. There's several participants, probably several hundred participants that there is a shortfall with the collective revenue or their balance can't accommodate that fee. So TIA has covered that shortfall. So what we're really trying to assess today at the bottom of this page is the $49 per participant fee that TIAA is assessing for the University of Maine defined contribution relationship. So what we did, because we have obviously a number of other institutions that are clients of CapTrust, we don't need to go to an external source to look at that. We are assessing your fees based on other plans that are similarly structured. So if you look at, these are 4 plans that CapTrust maintains today. You'll notice again at the top, the 177,000 combined average account balance, the $49, if you look at an asset-based term, that's 2.76 basis points. So we're assessing the reasonableness of those fees. And so you look at the bottom, we have one plan, average account balance of 187,000, a little over $1 billion in assets. Their per head fee is $52. Again, 49 below 52. That's a good thing. And then you look at both sample plan B, C, and D, and in every scenario, we feel really good that the University of Maine relationship is having such a competitive fee vis-a-vis other plans that are similarly structured. If you look at, like, for example, sample plan B has lower average account balance, so we would expect them to have a slightly higher fee than the University of Maine relationship. The one thing I would say is, like, sample plan D, I'm like, okay, if I'm the advisor on that plan, I would be calling TIA today to renegotiate those fees. But for today's discussion, your fee, we feel very good at net that the $49 per participant fee is actually slightly below the current benchmark range. And that's really what we want.
And Barry, the only thing I'd add to that is with the threshold increasing from $5,000 to $7,000, that actually may bring that average account balance up slightly and allow us to go back to them and perhaps even negotiate lower fees based on that increase.
Are there any questions or comments on the fee benchmarking?
Anyone?
The other thing that we do periodically is we want to make sure that we are taking advantage of the lowest share class available in the marketplace. Again, anytime you have a decrease in fee, that there's a direct correlation to it, to increased return at the individual participant level. So periodically we want to survey the funds that we're in and where they stand in relation to their fee. So the next couple pages are just an analysis of this. And so as an example, the CREF Social Choice account, their fee is 7 basis points. The bottom 25th percentile fee is 70. So they are so far below the average peer group. Obviously, they have a lot of assets, so they certainly have some leverage with that, but very good that we have a very, very low fee in relation to the marketplace. I'm just pointing a few here, like the Vanguard, the total bond market fund, their fee is 4 basis points. The bottom 25th percentile is actually 3, but clearly below the universe median at 7. So we want to make sure at least we're below median, if not below the 25th percentile. So it's an inverse relationship. So the lower that is, the more competitive your fee is. And it's going down top to bottom. We don't have any concerns on any particular fund. If you see going down, like I think in every case, we're at the bottom 25th percentile. If not, we're slightly above the bottom 25th percentile. So net's a really good thing. The only fund on this page, the only fund that we saw where there is a lower share class is the Victory Sycamore Small Company Value. This fee, they have a fund, the R6 version is 85 basis points with a 0 revenue share. If you look at the Victory Sycamore Small Cap Opportunities institutional share class above the third line down at the top. The fund we're in today is 89 basis points. However, this fund has a 10 basis point revenue share, so their net investment cost is 79. So even though the R6 version has a lower share class, we're actually in the better fund because we're giving all that revenue back to the individual participant. So even in this case, we are not recommending any change to this because we are in the net cheapest share class available for this particular fund. I want to make sure everybody understands that. So the 89 embedded within the 89 basis points is a 79 basis point investment management fee and a 10 basis point revenue share that TIA gets, and TIA passes that revenue share back to those participants that are in this fund. So on a net basis, the fee is 79, and we could go to a different share class, but the share class doesn't share revenue, and it would be 85, so it would actually be a slightly more expensive on a net basis. That makes sense?
Yes.
Okay. So we're in good shape in this area as well. The last item we wanted to talk about is the investment policy statement. And I apologize. When I scanned this, my printer wasn't cooperating so well. It's a little, the left-hand side is a little faded there, but periodically, what we want to make sure of, while we don't follow ERISA, it's certainly a best practice that we periodically review the investment policy statement and affirm there are no changes to it. So we think it's part of the kind of fiduciary hygiene of effective committees that we would look at the investment policy statement periodically to determine if there are any changes to it. We reviewed the investment policy statement. We did not see any things that would necessitate a change, but if the trustees have not had a chance to look at this and maybe we reaffirm it at the next meeting, I am comfortable either way. But if you have not had a chance to review it, we would at least acknowledge that you probably need to have some time to review it. Again, this talks about roles or, purpose, roles and responsibilities. We spent some time, and it was, I think Tracy and I signed this May of 2023. So it's been about a year.
So is the committee's preference to have another quarter or so to review, or would you like Barry to maybe just quickly walk through the highlights, being it hasn't changed since last year? He's making no recommended changes.
Right.
I'd like to see just to quickly overview.
Okay.
Walk through. Yep.
So again, yes, this is your investment policy statement. We have an investment policy methodology, but what the scoring system Mike just talked about, we if there were any changes to the investment policy methodology, we would inform the trustees of that. There are no changes to our investment policy methodology and the manner in which we are scoring funds. But for this IPS, we have a statement of purpose, provide benefits for plan participants, certainly provide, as Mike had talked about, a core menu of funds that, based on their individual risk profile, that they can achieve their retirement objectives. But if you look at the policy goals, the goals certainly establish roles and responsibilities of the fiduciaries, making sure we follow a prudent process when we are evaluating funds in the plan, minimum requirements in terms of tenure of the manager team, assets under management, all those sorts of things, fees, extremely important in today's framework. We do look at certainly the fiduciaries and making sure the investment policy statement is a guide. It's not so restrictive that if a fund, as Mike had alluded, if a fund scores a particular score, then we must act. The investment policy statement is intended to have a discussion on it, but ultimately that lies with the trustees to determine whether or not it's prudent to make that determination whether to replace a fund or not. So it's a guideline is flexible, but yet we certainly have some goalposts and parameters by which we operate. Certainly responsibilities of the consultant to evaluate funds, be an active member of this committee, making sure we provide salient and relevant information for particular funds that might be struggling. Mike talked about Harbor as an example, or Europac as an example, where we would dig a little deeper into those particular funds that might be struggling based on the current capital markets. Asset classes, what asset classes should we offer to plan participants? This is where we spend a lot of time initially, like what should be the core asset classes for inclusion. That's why we also offered brokerage, because there could be opportunities where a participant, they can't fulfill their individual allocation within the core menu. So the brokerage window could be that kind of pressure release valve to where they could have maybe some more non-traditional types of asset classes in there. Again, how we select investments, fees, consistency, volatility, diversification. We want to make sure we're well diversified, the funds that we have in the plan. Certainly performance. The goal is to have funds that perform above the 50th percentile on a longer term basis, 3 and 5 years. There's always going to be pockets where that may not occur. That's why we talk about it, like the Euro Pacific Growth Fund as an example. Solid management teams, making sure that they have a solid process. We spend a lot of time forward looking in terms of interviewing portfolio managers, like how are you sourcing ideas? What is your bench strength like? What is your compensation structure like? So a lot of things that factor into the sustainability, the long-term consistency of the fund that we are recommending to plan committees. And then we talk about the scoring system that Mike just went through. And to the extent that we have a fund that is underperforming, and we will always, CapTrust will always come to the table with a clear recommendation, whether we recommend we hold the fund or if there is a recommendation for the various factors that we would discuss that we would think it might be time to move off that particular fund. I think all these are really contained within the IPS, and clearly brokerage. We just talked about brokerage, making sure we have access to a brokerage window for those participants that want to fulfill ESG. I know you had a session last with NEPC about ESG. Like if somebody has a particular view of ESG, brokerage windows have plenty of options out there that align with their particular worldview.
Okay, thank you. Do you have anybody have any questions?
Chair Martin, can I just follow up on the reference to ESG? Is there a need in this policy to make any reference to our fossil fuel divestment strategy? Is it covered in the generic language?
Short answer, I would say, is no. But from the trustees' perspective, should we have some line item ESG? I mean, Craft Social Choice, is one of the funds that we have in the plan today that has some ESG screens.
But it is not a fossil fuel free fund.
Yeah.
I would say that goes back to
the
importance of the self-directed brokerage account, and because it's a participant choice plan, if the goal of the participant is to not have exposure to fossil fuels, that's where that self-directed brokerage account is so important.
Yeah, as long as we think the generic language is adequate, that's good.
Yeah, I would prefer to keep the language as is, and if somebody says we ought to change it, then we could consider at the time. But
Chair Riley, this a lot of what we're discussing right now is participant accounts and not the
I know.
three
No,
portfolios. Yep.
I just don't want anything that could be viewed as inconsistent. And I think this item 8 is fine.
Yeah.
Okay. All right. Well, any other questions, concerns in regards to the investment policy statement? Looks like we're good here. So thank you, Mike and Barry, for your comments, your guidance, expertise. We're now at the tab 8, defined contribution investment policy statement. I'll read the text of the proposed resolution. That the Board of Trustees, acting through the Investment Committee, reaffirms that the current defined contribution plan investment policy statement reaffirms the current defined contribution plan's investment policy statement with no changes. Do I have a motion?
So moved.
And I'll be the
Or second, either one.
All right. So we're going to go Trustee Moore moves, Trustee Riley seconds. And I'll transfer it to Beth, Clerk of the Board, for the roll call vote.
Okay. Trustee Martin,
Yes.
Trustee Riley,
Yes.
Trustee Moore,
Yes.
the motion carries.
Excellent. Thank you. Thank you, Mike and Barry. Have a nice,
Thanks, everyone.
have a
Thank
nice
you.
Memorial Day at the beginning of the summer.
Yep.
We'll see you. And next, I'd like to have a motion to move into the investment committee to go into executive session under the provisions of 1 MRSA section 405(6)(c) to discuss the condition, acquisition, or disposal of real property or economic development if premature disclosure of the information would prejudice the competitive or bargaining position of the University of Maine system. Can I have a second?
Second.
Thank you, Trustee Moore. And Beth, can you take a roll call vote?
Yes. Trustee Martin,
Yes.
Trustee Riley,
Yes.
Trustee Moore,
Yes.
the motion carries, and I will move you into executive session.
Thank you, Beth.